Hi, I'm Wes Long, President of Index Fund Advisors. Welcome to IFA, where we replace speculation with an education. Today, we are honored to have in our studio Eduardo Repetto, the Chief Investment Officer for Avantis Investors. In addition to his duties as Chief Investment Officer, Eduardo directs the research and implementation of Avantis' investment strategies. He oversees their investment team, their marketing initiative, and works with clients. Prior to Avantis, Eduardo was the co-CEO, co-chief investment officer, and director at Dimensional Fund Advisors. Dr. Repetto earned his PhD in aeronautics from California Institute of Technology. He has a master's of science degree in engineering from Brown University, and his undergraduate degree in civil engineering from Universidad de Buenos Aires. He's also a trustee of the California Institute of Technology. Eduardo, welcome.
Thank you, Wes. It's always a pleasure visiting you and visiting IFA. You know, we know for such a long time. It's always great to come here.
A very long time. Yes, indeed. Yeah. So tell me, a PhD in aeronautics, a master's of science in engineering, and you're doing investing.
And yeah, well,
how does that happen?
Things happen in life. You know, you never know what, but things happen in life. Before going to grad school, after my undergrad, I worked a little bit with a mathematician. So a PhD in mathematics from Caltech, Luis Reina, just bright guy, amazing guy. And he was the head of differential equations in the IBM Research Center in upstate New York, in Jordan Heights. And I learned a lot from him. And at some point, he switched from, differential equation, that is some weird math, let's call it, and switched to Wall Street. And he did it because the tools that he knew, the technical tools that he knew, could be applied to other problems, not only the scientific problems that he was trying to solve for IBM. Okay. And he said, look, this is quite a lot of fun. When you do a career in science, you develop a lot of knowledge about different set of tools. Mm-hmm. And those tools can be applied to science, but also can be applied to other topics like financial science, that's science, or marketing, or any other field that you can imagine. And so that inspired me. So when I finished my PhD at Caltech, I have to make a decision. The decision is, do I continue in academia, becoming a professor, or do I do something else? And something else could be, working in engineering field or researching in any kind of company outside academia, or doing something completely different. And I said, let's try finance. And it's quite common to have people from technical backgrounds to move to financial sciences and investments. We are lucky to develop, as I mentioned before, a process to learn things, a process to advance science, and that can be applied to investments, and that's how it happened. Professorship, professors, being professor in university is a prestigious thing and a great thing, but it wasn't really for me. I really wanted to work in something different. My projects in academia were very long-term projects, research projects that you could spend years or decades without seeing the outcome. In some cases, you never want to see the outcome because it's weapons, that you really don't want to see how they work. If you imagine what weapons I'm speaking about. Yeah. I really wanted to work something that you can see the effects of your work in people's life and try to see how you are contributing for the well-being of people. And I think you can do medicine, but no, that's not for me. That's, I cannot deal with blood and all these things. I can't. So, but finance is a place where you can apply your knowledge, your hard work, in order to try to improve people's life, and you see the effects in your lifetime.
Well, and based on the leadership that you've demonstrated in financial services and the number of clients ultimately that have benefited from that leadership, I think you probably chose the correct path. So
thank you, Wes. Thank you.
So Avantis. Tell us about Avantis. Who is Avantis?
Well, Avantis Investors is a unit of a large company called American Century. So we created Avantis Investors like 3.5 years ago with the goal of bringing cutting-edge financial science, very good investment structures that we will speak in a minute, like ETF, not only just mutual funds ETF, that have some advantages, and also very attractive fees to the market. Why? Because if I have a cutting-edge investment strategy in very tax-efficient vehicles and with low fees, any investors are better off. My goal is to help you, Wes, and advisors in general deliver better solutions for their clients. Because if you are able to deliver better solutions for your clients, they are better off, and all of us become happy. Our success depends on having this end client have a better outcome. And so we have to worry about all the different components that come into facilitating that better outcome.
So when you say attractive fees, you mean low fees for the client, not attractive fees to Wall Street, right?
Oh, no. Low fees. And we came with fees that we are just shocking to the industry, because basically we shake everyone up saying, look, these guys in Avantis are coming with fees that are way lower than other fees that are out there. And for value-added products was just basically a breakthrough for advisors and for end clients. And so we were able to deliver something that it certainly adds value to the end client. And if I can help you help your clients are happy, you're happy, we're happy.
Yes, indeed. So in addition to low fees, tell us about the investment philosophy advantage. How do you implement that philosophy?
That's a great question. So first, we care about trying to have well-diversified portfolios. But we care about having well-diversified portfolios that can have higher expected returns. Mm-hmm. You can imagine that in the market there are tons of securities. Not all the securities have the same expected returns. Some securities in the markets are priced with a price that is a little bit higher than others related to the fundamentals. So the securities have a higher price related to the fundamentals. They have low expected return, and the securities, the price happen to be very attractive. And in order to identify which securities are priced in the market with attractive pricing, you need to use financial science. So what we do is we use cutting-edge financial science to understand what securities are priced in the market with a big discount rate. So the price in the market is a price that is attractive, is low relative to the fundamentals of the company, the cash flows, the equity, the balance sheet of the company. If you are able to identify those companies better, you are able to create better portfolios for your clients. And your clients will have better expected outcomes. And you can do that in a diversified way, just to try to minimize uncertainty and risk. There is no need to take risk beyond the risks that are inherited in the business of investing in equities and fixed income. So what we do is just deliver portfolios that can be used in a seamless way in broad asset allocations, so the advisor can deliver value added, minimize risk, and have all that at very attractive fees. And on top of that, with extreme tax efficiency.
We're going to get to the tax efficiency part here in a minute, I think. But what you just described, I think, is commonly referred to as value stocks or value investing. Would you agree with that?
Yeah, that's a very good question. So value investing is trying to buy, like you go to a restaurant. You go to a restaurant and you say, oh, look at the restaurant I went the other day. It was magnificent. I didn't pay too much. Well, that was value for you. So value investing means that you're buying securities that have some attractiveness to you. The attractiveness in general is on the expected returns. So, but the definition of value changes across people and changes across time, because 20 years ago we knew less than what we know today, and in the future we'll know more than what we know today. So the conventional definition of value that people use is low price securities. I have a low price security, so since the price is low, that must be a value buy, something attractive to buy.
So I should buy all the $1 stocks?
Yeah, that's where I'm going. That's the definition, traditional definition. And you see that traditional definition across index funds, across managers. But a more cutting-edge definition is not just focusing on low-price securities. A more cutting-edge definition is trying to find companies that the market is pricing at a big discount. So remember that I told you not every security in the market has the same expected returns. Some securities have higher than other expected returns because the market is pricing those securities with a big discount. Think about the cash flows that the company is expected to get in the future. So the cash flows are based on the prices of the pricing of the company. But if you have a big discount, those cash flows are heavily discounted when the market is coming to that price. Yeah, okay. And so the new, better definition of value is not low price security. It's having securities that the market is pricing a big discount, because a big discount is high expected returns. I always think about this. We brag when we go to restaurants and we find a good restaurant and we tell our friends, hey, I went to eat this sushi, it was amazing. But you don't brag if you go to a restaurant and the price is low. The price has to be low, but the service good, the food good. Because if it's just about low price, you will buy sushi in a gas station. I say, oh, you're not going to brag about that. So you brag when you have all the good qualities and also good price. This is the same. What you want is companies at the market is pricing at big discount. This, in spite of having good fundamentals. So the price is low because the market is discounted those companies' prices heavily.
And do academics influence or inform your investment strategies at Avantis?
Absolutely. You really have to think about financial science back in everything that you do. So the way we think about that is, many people just rely on empirical data. And empirical data is you go to look at things that happened in the past and find that certain securities do better than others. The problem with just relying on empirical data is things may happen in the past, but you don't have any expectation of them happening in the future. So we do a little bit more than empirical data. What we want is to have a theoretical framework why this should persist in the future.
I see.
And the theoretical framework that we use is valuations. At the end of the day, valuations matter. It matters when the Babylonians were trading donkeys, 3,000 years ago, and it will matter when in the future. If we live in Mars and we are trading water and oxygen, it will be the same. It's valuation. So how much you pay for a service, how much you pay for a cash flow, how much you pay for the balance sheet of a company. And so a theoretical framework based on valuations is what informs us on expectations going forward. But the theoretical framework needs to be backed by empirical data, because if not, the theory doesn't fit reality. And so what we demand in the strategy that we have is a theoretical framework that is well recognized and is backed by financial science, and then empirical data that says the theoretical framework is realistic, fits reality, and it should work going forward. So when you have that, you feel comfortable about your strategies, and that's what we pursue all the time.
So let's talk a second about small stocks versus large stocks. There might be a perception out in the marketplace by investors that you want to buy large, well-known companies, always. Is that?
So this is a great question. We were speaking about not all the companies having the same expected returns, and this is true. So it doesn't matter if the companies have large caps or small caps. You probably want a little bit of all of them. But when you're thinking about expectations of outperformance, expectation of high expected returns, you have way more small cap companies than large cap companies. Some of these small cap companies are not so widely followed than the large cap companies. So when you're looking at price of the company and discount rates of embedded in that price, the market is coming to a price based on the discount rate that can be inferred from that price. If you're looking at the dispersion of valuations that you see in small caps, you can find much higher expected returns than you can find in large caps. And this is, for example, if you look at the value stocks in small caps, you can find that value stocks in small cap have had in the past, and based on valuations, are expected to have much higher expected returns than stocks in large caps that are trading at a very high price relative to the company produced in cash flows or the balance sheet of the company. So small caps gives the opportunity of deliver higher expected returns and enhancing the overall performance of the asset allocation that you are putting for your clients.
A key word that you just mentioned, asset allocation.
Asset allocation.
Based on what you just said, why wouldn't everybody go out and just buy a portfolio full of small cap value stocks and be done with it?
That, and I'm not telling you that there will not be one person that's the right portfolio, but for most of us humans, that's not going to be the right portfolio. So there was a breakthrough research, and this is you have here in IFA the drawing of Harry Markowitz.
Yes.
And so what's the breakthrough that Markowitz have? So this idea of portfolio asset allocation didn't exist. I'm speaking about long time back, 70 years ago. The idea of asset allocation didn't exist. The idea of portfolio didn't exist. The idea that existed at the time is the idea of expected returns, just expected returns. So if you want to maximize expected return, and I tell you the expected return of all these 10 securities, if you want, the only goal is maximize expected returns, you're going to buy one security, the one that has the highest expected return. But Harry Markowitz discovered, that doesn't seem to be the right thing, because you have to trade off, you have to balance the expected returns and the risk that you take, the diversification that you want to have in the portfolio. So there is a trade-off between how much you want to push to get expected returns and the diversification that you want in the portfolio. So if you just want higher expected returns and you don't care about diversification, you may buy one name, one small cap company with high profitability and very low price relative to the equity. And you just buy that one. But that's not really probably the right portfolio, because it's too much risk. It's more of flipping of a coin. It's a little bit on the speculation based on education. So if you look at the concept from Harry Markowitz, they say, no, you have to balance that expected return that you're searching with the diversification that you need in the portfolio. And that's the concept of portfolio started to take place. What is called risk-return trade-off, if you want. And then the asset allocation is just creating a good portfolio that delivers diversification and also enhances performance.
Yeah, you're right. I think for literally decades before Markowitz, people didn't think about the correlation between risk and return. If you want more return, there's got to be, by definition, more risk involved in that return. And your example of one stock might work well until March of 2009 rolls around and you're down 80 or 90%, and then what? Then you get scared and you sell and you basically lost everything that you invested. That's why diversification, I think, makes more sense for the average investor. Would you agree?
Yeah, absolutely. And it's even more simple than that if you want to think. Say, when we're estimating expected returns of companies, so I told you this security has the highest expected return. Well, you can imagine that there is estimation error there. How can you do the exact expected return and know that that one is higher than the second one?
Yeah.
So you have estimation error in everything that you do. How tall is my son? Well, I have one that is around 6'3", but it may be 6'4" or 6'2". I haven't seen him for a couple of months because he's in UC Santa Barbara. So I don't know. There is an estimation error in all that. The moment that you recognize that there is estimation error, the more important diversification is. And when you put together portfolios for your clients, you're thinking about the estimation error. You're thinking about the risk tolerance that your client has. You're thinking about the need to reach for higher expected returns. And that's a beauty that an investor can speak with people like you, Wes, that have the knowledge to understand what they need and how to put together portfolios for their future.
Yeah, in our opinion, it's vitally important to match someone's capacity to handle risk with their exposure to that risk. And we spend a fair amount of time educating investors on why that's important and helping them to get to that correct allocation of risk in their portfolio.